Welcome to the Deep Dive, where we take your source material, your earnings transcripts, research notes, and turn it all into actionable, memorable knowledge.
Today we are tearing into the results from the Exzeo Group, ticker Exzeo.
And this was a really critical moment for them. This was their first earnings call as a public company, right? They just IPO'd in early November.
Exactly. So the spotlight was incredibly bright. Everyone was watching for guidance, for execution, for just the tone from management.
So for anyone who's just getting up to speed on the name, who is Exzeo?
They're a tech provider for the property and casualty insurance market, P&C.
Okay.
Specifically homeowners insurance. And they run on this model they call insurance as a service.
That sounds like, a bit of tech jargon. What does that actually mean in practice?
It's the key to their whole business, really. So instead of an insurance carrier building out this huge, expensive internal IT system.
Right, to manage policies and all that.
Exactly. They just outsource the whole brain of the operation to Exzeo's platform. And the way they get paid is really smart. The carrier pays Exzeo fees tied directly to the amount of premium being managed on the platform.
So their incentives are perfectly aligned. If the insurance company grows, Exzeo automatically grows with them.
You got it. It built in this amazing visibility and durability.
Okay, so speaking of performance, let's get to the numbers for Q3, because on paper, these results looked, phenomenal.
A textbook beat. No question about it.
So on profitability, GAAP diluted EPS came in at 25 cents. The consensus was looking for 21.
A solid beat.
And then revenue, 55.17 million, which was also just ahead of the 54.4 million consensus. But the real headline has to be the growth.
Oh, yeah. That revenue number, that's up 90% year over year. 90, from just 29 million a year ago.
So here's the puzzle. And this is really the mission of our deep dive today. You have this massive beat, explosive growth.
Right.
And the stock sold off after hours, down about 1.4%.
It's a total head scratcher on the surface. A huge operational win gets punished by the market. Why?
And the answer isn't in the Q3 numbers they just posted. It's all about the guidance and the Q&A.
That's all about the forward look. But before we get to the negative, we really have to appreciate just how good the margin story was in Q3. It validates everything.
So I saw this number, a 55% EBITDA margin. In this industry, that sounds almost too good to be true.
It's a fair question. But management was really clear. They said this is just pure platform efficiency. Adjusted EBITDA hit 28.7 million.
Which gives you that 54.9% margin. And that's up from what, 32% a year ago?
A 23-point margin expansion in a single year, while growing revenue by 90%.
That's almost unheard of.
It's the as-a-service model in action. Think about it. For every new premium dollar they win on, they don't have to add another employee or another server.
Yeah.
The platform's costs are largely fixed.
So they can add what they call managed premium with very little extra expense.
That's the idea. And that managed premium number is the real fuel for the business. It's the lead indicator for everything else.
And where did that land in Q3?
It ended the quarter at about $1.22 billion. That is up a staggering 142% year over year.
Okay, so the actual business flowing through their system more than doubled in a year.
Right. And that feeds into their annual recurring revenue, their ARR, which hit 192 million. And on top of all that, they're sitting on a fortress balance sheet.
Debt-free, right, with about 140 million in cash.
And that's before the 155 million they just got from the IPO. So they are completely capitalized to scale.
Okay, so the model works. The margins are huge. They've got the cash. They've got the growth. So let's get to the but. What happened?
Let's talk about the timing bridge. This is what spooked the market.
The sequential deceleration scare.
Exactly. There were two things that caused confusion, and they're both tied to timing. First was the Q4 income guidance itself.
Which was surprisingly low.
Way lower than you'd expect. Management guided Q4 pre-tax income to a range of $22 to $25 million.
Okay, wait, hold on. They just posted over 28 million for Q3.
You see, the guidance implies a sharp sequential dip in income from 20 million down to maybe 22.
And if you're a new IPO investor just watching quarter over quarter numbers, that looks like a giant red flag.
It screams deceleration. And management had to spend a lot of time explaining the reason, which is the second point. This premium to revenue lag.
Okay, break that down for us simply, because this seems to be the entire key to the confusion.
Okay, think of it like this. Exzeo signs a huge new insurance carrier in Q4. That's a massive win. That new business counts towards their managed premium goal for the year.
Right. The contract is signed. It's locked in.
But because of accounting rules, they can't actually recognize most of the revenue and the income from that new client until the policies are fully running on the platform. And that doesn't happen until 2026.
So the business win happens in Q4, but the financial benefit, the number that shows up on the income statement, is delayed.
Perfectly put. They explicitly said Q4 is their strongest quarter for adding new premium. But that premium converts to revenue in 2026, not 2025. And that perfectly explains the Q4 income dip.
But the underlying business is still accelerating into that.
Massively. They confirmed they now have 6 carrier clients. They just added the 5th in Q3 and the 6th in Q4.
And the long-term targets for that managed premium are still huge.
They're guiding to at least $1.32 billion by the end of this year, 2025, and then hitting $1.5 billion by the end of 2026.
And the income guidance for 26 reflects that acceleration then?
It does. Full year 2026 pre-tax income is guided to between $115 and $125 million. A huge jump. It shows the leverage is there, it's just delayed.
So let's talk investor context. The stock is trading, what, about 5% below its IPO price of $21. It's a classic show me story at this point.
Absolutely. But underneath that skepticism, the operational signals are really strong. Did you catch what they said about the sales pipeline?
I did. This was genuinely stunning. In the 5 weeks since the IPO, the pipeline for new clients has tripled.
Tripled. That's incredible velocity. And what's more important is that the pipeline is getting more diverse geographically.
Moving beyond just Florida, which is a big risk concentration.
A huge one. They're seeing a lot more non-Florida prospects, which helps de-risk the whole story.
Okay, so they're adding all these new clients, building out the sales team. That has to cost money. How do they maintain those incredible margins while they're spending to grow?
That was a great question on the call. And management's answer was really telling. They said that the new premium they onboard is actually expected to come in at a higher incremental margin than the existing business.
So the platform just gets more efficient as it gets bigger.
That's the argument. The leverage is so powerful that even with more sales spending, the overall margin profile should continue to expand.
Wow. And if that wasn't enough confidence, they finished with the ultimate insider signal.
The 10b5-1 plan.
Yeah. Explain that for the listener. This isn't just an executive saying they like the stock.
No, it's a legally binding prearranged purchase plan. A member of the executive team has committed publicly to buying an additional $2 million worth of Exzeo stock on the open market all through calendar year 2026.
So it's scheduled in advance. It can't be timed to any news.
Correct. It's the ultimate bullish signal. They see this short-term dip, this confusion over timing, as a huge opportunity to buy more of their own stock before the market figures it out. Okay, welcome to our This Is Not Financial Advice segment. We've laid out the core tension here. The business operationally is just on fire.
Right. High margins, massive growth.
But the accounting, the way the numbers get reported, is delayed. And that creates this dip risk in Q4 and maybe Q1 of next year.
So you have a short-term headache and a long-term powerhouse. What's the trade that plays that gap?
We're calling this one the strangle the quarter, bet the year trade. It's designed to capitalize on the volatility created by this timing mismatch.
I like it. Break down the two sides of that.
Okay, first you strangle the quarter. You acknowledge that Q4 income dip is real and the market's probably going to panic. So the action is to short the stock or maybe buy some near-term puts, targeting Q4 and Q1.
You're betting on the market punishing that sequential dip.
You're betting on that disappointment. You're harvesting the fear.
Okay, that's the short side. How do you bet the year?
At the same time, you take all that conviction about the long-term story and you buy deeply in the money 2026 call options. You're making a leverage bet on management hitting that huge 2026 guidance.
The $115 to $125 million in pre-tax income?
Exactly. And the $1.5 billion in managed premium. The bet is that eventually the market wakes up and realizes the operational leverage is real, it was just delayed.
It's a classic play on short-term noise versus long-term signal.
That's the idea. And of course, we have to say, this is strictly for illustrative purposes. It is not financial advice.
All right, so to wrap up this deep dive on Exzeo Group, they delivered a fantastic Q3. Clear operational leverage, 55% EBITDA margin, and just massive growth in managed premium.
But the key takeaway is that tension. The market sold off because Q4 guidance looks sequentially lower, It's not a business failure. It's an accounting and timing issue. The huge amount of new business they're signing now just won't show up in the revenue line until 2026.
So if you're trying to cut through that noise, what's the one metric you should be watching?
I'd look at their cash conversion rate. In Q3, they converted 140% of their net income into free cash flow.
Wow.
It's incredibly efficient. The big question is, can they maintain that kind of cash generation as they scale from 6 carriers to, 10, 12, 15? That efficiency is what defines a truly great platform business.
That's the ball game. So if you're looking at this name, watch the forward catalysts. First, what is that final managed premium number for year-end 2025? And then early in 2026, you need to look for the proof that those new carriers are finally hitting the revenue line. That's when the real story should hit the tape.